So how do you short a stock and how do you make money from something when it goes down in price? So today we're going to have a quick look at how you do that. Now, most people think about making money in the stock market by buying low, waiting for the price to go up, and then selling at a higher price. It's fairly straightforward, easy concept to get your head around, and that's known as going long. But you can also do the opposite, that's called going short. So, easiest way to talk about this is via an example. So this is probably going to be a bit of a weird example, but stick with me here. Now, let's pretend you have a friend called Roger who wants a car. You also have another friend called Liam who has a car but doesn't need it right now. So what you do as the middle person is you borrow the car from Liam and you sell that car to Roger. So let's say you sell it for, I don't know, £10,000. So what you've just done is sell something you don't own. So you've got a handful of cash now, but you still owe that person the thing you just sold. So on the one hand, you've got the asset of the cash, but you've got the liability of still owing the person, Liam in this case, a car. So now let's say some time passes and Liam comes back to you and says, hey, can I have my car back? Which is a fair request. And that's when you realise you've got £10,000 but no car. So it's time for you to go and buy a car in the market. Now, fortunately for you, the car you sold for £10,000, you can buy in the market today for £9,000. So what you do is you go out, you buy that car for £9,000, give it back to Liam because he lent it to you in the first place, and you make that £1,000 difference is your profit. So you've just successfully shorted a car, which is a bit weird. So when it comes to the stock market, you're effectively doing the same thing. You're borrowing shares off somebody who already owns them and selling them in the market at today's price. And you're hoping that they will drop in price over the next few hours, days, weeks, whatever it might be, so that you can buy them back at a lower price. You can give the person you borrowed the shares from, give them the shares back that you've paid less for, and your profit is the difference in price. So let's say today the share price of something is £10. What you can do is you can borrow shares that are currently trading at £10 and you can sell them at £10. You still owe somebody those shares, but in a week's time you can buy the same shares back for £9. So you buy the shares, give the shares back to the person you borrowed them off, and you make £1 per share. Happy days. Now the risk here is that the shares don't drop in price. So if you borrow those shares and sell them at £10 today, what happens if in a week's time the shares are actually worth £11? You still owe that person however many shares you borrowed, and you have to buy them back at £11 so you can give them their shares back. So you've now lost £1 per share. Bad times. So that's the big risk with shorting. And as you might have worked out, there's a limited upside. So if you borrow somebody's shares for £10 and the share price drops to zero, you can make £10 per share. That's pretty good. But if you borrow someone's shares for £10, they could go up to £20, they could go up to 30, they could go up to 100. So there is no downside limit to how much money you can lose, but there is a limit on how much money you can make. So that's a big risk with shorting, and that's how it can go quite wrong quite quickly. And we're going to look at that extreme example now. Now, that was a very quick overview of what shorting is, and the reason I've not gone into a massive amount of detail is just so you know enough to understand what I'm about to talk about. So the big headline at the moment is GameStop and how vigilante individual private investors are taking on Wall Street and winning. And the main point of all of this is it's around shorting. So I'm not going to go into a massive amount of details, but I'll try and give you a bit of background to it. So there's a company called Gamestop in America. They're a physical store, a bit like Blockbuster, sell games and that kind of stuff. And they've not been doing well. They've been losing a lot of money recently. And for the past couple of years, it looks like they're about to go bust. They got a new board member, and there was talk that maybe they could try and compete with Amazon for the particular niche that they're in, the gaming side of things. And so the share price kind of perked up a little bit. But when the share price started to perk up, a lot of the hedge funds and the Wall Street types, they decided that, no, it's not going to turn around. This company is going to go bust. And so what we'll do is we will short that stock. So they were borrowing stock from people who owned it, and they were selling it at today's price, and then wait for the company either to go bust or to drop so much lower that they could buy the shares for pennies, cents, and get the difference in price. That was going to be their big profit and their big payday. Wall Street Bets, which is a subreddit on Reddit, they cottoned onto this, realized that there was actually 102% of the shares in circulation had been short sold. So there was a massive shorting on this particular company. And for some reason, they got a bit arsey about it. And so they decided to fight back. And what they did is they started a community and started a viral sort of trend to actually prop up the price of this. So if you think about it from the hedge fund's point of view, they have borrowed shares at $10, sold them in the market, and they're now waiting for it to drop to, say, $5. They're going to buy the shares at $5, give it back to the person they borrowed the shares off, and make $5 profit. Happy days. That is their goal. So what the Wall Street Bets people have done is they've created a community and said, let's go screw with these people. Let's go and buy up as many shares as we can. So instead of it dropping to $5 a share, it's going to go up to $20 a share. And so the hedge fund are going to have to come back into the market and buy at $20 in order to give the person that they borrowed the shares off in the first place those shares back. So the hedge funds are going to lose $10 per share that they borrowed. And it gained a bit of momentum. And so it didn't just go from sort of $10 up to $20. It actually went from $10 to about $500. So what they've done is they've forced the hedge funds who sold, thousands of shares, probably millions of shares at $10. They've forced them to go back into the market and pay $500 for those same shares, losing $490 per share. And obviously that's happened in stages. It's not just gone from $10 to $500. It's gone up over the last only about a week or so. But it becomes a bit of a spiraling situation because the hedge funds, they need to come back into the market and they need to buy shares. And then you've got all of the Wall Street bet types and all of the individual investors who are also buying shares. And so you've got multiple people competing for a limited number of shares, which is driving the price up. And so this is what's known as the short squeeze. All of the shorters, all of those hedge funds that have already sold shares that they don't even own yet, they're being forced to come back into the market and buy shares. And so they're being squeezed out of their short position, hence the name, and that is also driving the price up. So if you think about it, if you borrowed someone's shares and sold them at $10 a share, and then the price went up to 20, and you thought, crap, okay, I'll buy at 20, give this guy his shares back, I've made $20 loss, bad times. Hedge funds are kind of greedy. So what they've then done is they've looked at it and said, but actually, now what I could do is I could borrow those same shares and I could sell them for $25 because the price is going up. So I'm going to borrow those shares now and I'm going to sell them in the market at $25. And I'll wait for the share price to drop to 10 again, and then I'll make $15. So I'll make even more than I was going to the first time. Cool. And then the Wall Street bettors never stopped. When it got to $100, they're like, definitely it can't go higher than this. And so they shorted again, and then they got squeezed out at 150. And that pattern has repeated with probably not the same hedge fund, but different hedge fund, different people coming into the market and taking a punt on, well, at some point it's got to stop going up because fundamentally the company hasn't changed. The company prospects haven't improved. They're still massively loss-making. They're still probably going to close down, which is the sad truth of it. And there will be people that have made an absolute fortune in both directions. So there will be people that were buying the share as a very risky play at $2 because they thought, maybe it'll make a comeback. Maybe it will turn into the next Amazon for this particular niche. And they saw their shares go from $2 a share to nearly $500 a share. But on the other side, there will be people who have been, as I say, at each stage of the way up, they will have been shorting that stock. And now anyone who is shorting it at $450, $500 a share, it's dropped back down to 120 odd now. Those people will have also made a fortune. And now again, I'm keeping this very simplistic because the reality is what we need to throw on top of all of this is leverage. And that just makes the whole thing a lot more dangerous, but a lot more fun. Now, taking a step back and thinking, well, okay, cool, that was weird. Now, is this something you should be getting involved in? Probably not. It's hopefully useful to at least know how it works and what was the thinking and logic and process behind it. The reality, though, is it's completely random, kind of speculative, and fine if you want to play with some throwaway money, you can give it a go. You can follow these Wall Street bets who are renowned for making massive losses and massive profits because they are literally, clues in the name, they are just making bets here. And it's an odd little community. They kind of celebrate people making a massive pig's ear of things. So probably not the best place to go for financial advice, but do what you like. I'm also not a huge fan of shorting anything because of that big difference in there is a limited upside but an unlimited downside, as a lot of these hedge funds have now found out. I think the final aspect of this is nobody is going to feel sorry for any of the hedge funds that have lost money. These hedge funds were out specifically to make money on a company dying, and that company has employees, has a lot of people, I don't know how many people, but has a lot of people potentially relying on it for their income source. And these hedge funds were going to add zero value to anything but they were going to make a big profit off it. The fact that they've now made huge losses and potentially had been bailed out by other banks and other institutions, nobody's going to lose any sleep over that. Can I see this becoming something that happens a bit more regularly? Maybe, with the advent of easy to access finances, easy to access leverage for trading platforms. There is the risk that people get overexcited and just start trading things that they don't really understand, but they're having fun with. It's not necessarily a bad thing, but it does have longer term implications for valuations of companies. That potentially could be a bad thing in the long run for the economies of the world. So who knows what will end up happening in the end? That's anybody's guess, but hopefully now you understand what's happened with GameStop, why it's in the news every 5 minutes, what shorting actually means, and how an internet group has made a bunch of hedge funds lose billions of dollars. So yeah, have fun with that.